Hi, I'm Sanjay. In this episode, we are going to talk about whether valuation of startup is an art or science, what kind of equity dilution we need to do, what kind of cap table we need to build so that VCs get attracted. Most deals in the startup world break on valuations. Investors and entrepreneurs are unable to agree on a number on what kind of equity dilution and what kind of funding would be required for the startup. Both overfunding and underfunding are detrimental to startup health. Let's discuss underfunding first. When the startup does not have enough capital to build the right metrics so that the next round of funding happens or VCs get attracted, it dies natural death. So whatever money you will invest, you will lose. So you need to find out what is the right value for next 18 to 24 months the company is going to need and fund that amount of value. When you fund startup with large sums of money, their focus from business moves out and they start thinking about how to spend money rather than how to build business. I get questions both from entrepreneurs and investors alike. How do we value a company which does not have data, does not have revenue? What value will you put on this idea? It is very simple. This is what I do. I work with entrepreneurs, work on a plan for 18 to 24 months and arrive at a number what capital would be required to run the business and take it to a next level so that the idea gets attractive for VC in 18 to 24 months. Then leave enough equity on the table for incoming investors. As an angel or a first check or the seed stage investor, you are not supposed to take majority stake or look for taking large chunk of equity. You need to keep enough equity on the table so that the founders' interests are aligned at multiple stages of funding. In India, typically at seed stage, startup valuations are done from 6 crore to 12 crore, while they are raising across sum of 1 crore to 2 crore. Or if they are revenue generating companies, they would be able to command a valuation from 10 crore to 15 crore and their ability to raise across money from 3 crore to 5 crore is there. In both the scenarios, the equity dilution will be anywhere between 10 to 35%, never over 35%. Due to the disagreement of valuation number between investor and entrepreneur, there is a new form of agreement which has come up, which is called convertible note. This is a deferred way of putting a valuation number at the next price round whenever it happens across. So, in nutshell, valuations are just an educated guess.